Every ETF has a story, and some of them deserve to be told. ETF Stories from Resilient Advisor brings you some of the most interesting stories from the world of ETFs. Learn more by visiting etfstories.com.
Thanks for tuning in to this episode of ETF Stories from Resilient Advisor. My name is Jay Coulter, and in this interview, we're going to break down and learn about Risk Parity ETF from Envoke Advisors, symbol RPAR. My guests for this interview are from Envoke Advisors, Alex Shahidi and Damien Bisserier from Envoke Advisors. They are the index provider for the RPAR ETF. Gentlemen, thanks for joining me.
Thanks for having us.
All right, so I've been a longtime fan of risk parity strategies, from reading about Harry Brown in the 1970s and 1980s to the permanent portfolio to the work that Ray Dalio did. What first turned both of your attentions to the risk parity strategy?
Well, I've been following this for about 15 years, and it was introduced to me by Bridgewater, which is coincidentally also where I met Damien, as he was working there for about a decade.
Yes, and I was on the front lines at Bridgewater of describing the strategy and its various applications to some of the largest institutional investors in the world, which were clients of Bridgewater's.
Got it. And so what I've learned from academics is, some of the more appropriate ways to hedge tail risk are trend following, low volatility strategies, and risk parity. And executing on a risk parity strategy can be challenging to do on your own. I mean, Bridgewater's the largest hedge fund in the world. They have the resources to do it. You guys have put this in the form of an ETF, and let's get right down to how you guys are constructing the index that powers this ETF. Which one of you wants to take the first shot?
I'll start. Just taking a step back, the objective here is balance. We want to own assets that do well in different environments, so that you don't have to guess what's going to happen next. You don't have to guess what we went through in first quarter of last year or 2008 or any crisis in the past. You just want to be balanced, own things that do well in different environments, so that for the most part, you can have a portfolio that is resilient to these unexpected downturns. So the way we construct that is two steps. First, we understand that what drives asset class returns is how the economic environment transpires relative to what was discounted and expected. And we think of it in terms of growth and inflation. So there's periods where growth is improving and periods where it's declining, and the same thing with inflation. Right now, that's the big topic, is inflation. So we pick four asset classes: equities, commodities, tips, and treasuries, because those four react very differently to different growth and inflation outcomes. The second step, once we have that diverse set of assets, is we structure each of those asset classes in a way where it has a long-term expected return comparable to equities. So when you do that, you have four diverse asset classes, each of which you have a similar return and risk expectation. We can get into the details of that. And then when you package it all up into an ETF, you get all these efficiencies. So you have a balanced portfolio. It can be tax efficient. It can be cost efficient. It's highly liquid. And it's something that we would expect to have a return that's comparable and competitive with equities, with a lot less risk over time.
I noticed in my prep for this interview, there's a lot of content out there that talks about the 60-40 portfolio and comparing it to a risk parity type strategy. Damien, what are your thoughts on contrasting the two types of deliverables for financial advisors that are trying to build portfolios for clients?
So 60-40, I think, is the market standard, but in our view is very inefficient because it's largely concentrated in a single asset class, which is equities. So you have more dollars in equities, the 60%, and then that 60% is a lot riskier than the 40% in bonds. And so really what dominates your outcome is what's happening with the S&P 500. And so that in our view is fine, but it is very inefficient for the risk taken. Our goal with RPAR is actually to structure it in a way where it has a similar risk level, but hopefully a higher return. That's the target. And we achieve that, as Alex said, by holding a number of different exposures that are structured to have a similar return to equities. So you're really not giving up on return as you diversify out of equities. And then by holding things that are reliably different, meaning they do well in environments where equities do poorly, you end up with a much more diversified allocation, and that's how you get the more efficient, higher return out of a portfolio of assets.
So let's break down the asset classes for global equities. As far as the index is concerned, and then the ETF, how are you capturing that allocation or that exposure?
Well, our goal there is to have a broad equity basket because we effectively want to capture the risk premium that comes with equities. So the allocation is half US, half non-US, and the portion that's non-US is tilted towards emerging markets for two reasons. One is emerging markets have a higher expected return than developed non-US, and also perhaps even more importantly, it's a better diversifier relative to US because many of those economies are in very different parts of their cycle and they'll zig and zag differently from the US. So half US, half non-US with a tilt towards emerging markets.
And was that a decision you guys made based upon some research in terms of the 50-50 allocation with the bent towards emerging markets? Or is this an active decision that could change in the future?
Well, our goal with RPAR is to develop a neutral portfolio that is a passive allocation that should stand the test of time looking forward. So that's the objective, and we want to try to achieve that by being as tax efficient and cost efficient as we can. And the other big objective is to keep it simple. We're not trying to be active, and we also don't want to get overly complicated. Because the part about this that is the most compelling is the diversification attributes of putting together a balanced allocation with this approach. So we don't need to get too specific about fine tuning. So that's how we ended up with half US, half non-US.
Got it.
I'd also say that some of those emerging markets, they have a benefit of slightly lower correlation versus the developed markets. So, and when we think about where the world is headed, those capital markets and those economies are growing faster than the developed world. And so we think it's likely that those economies and capital markets will be a larger portion of the global markets, in the future. And again, we're trying to design a perpetual strategy for the long term.
This episode of the Resilient Advisor Show is brought to you by the Independence Incubator.
Going independent is incredibly rewarding, but most advisors don't end up in the best place for their business. They instead end up getting sold by smooth-talking recruiters, custodian reps, or worst of all, aggregators who don't have their best interest in mind. The Independence Incubator from Resilient Advisor takes a fiduciary approach to independence. Our clients pay us directly for unbiased guidance on the best path for their business. Don't get sold, get educated, and get unbiased guidance. Visit independenceincubator.com to learn more. So, Damien, when we look at the exposure in the portfolio to commodity producers, how are you capturing that?
So we wanted to get as close to the underlying commodity prices as possible to provide the best inflation hedge. So we actually designed a custom index made up of about 35% energy, 35% industrial mining, 20% agricultural related companies, 5% clean energy, and 5% water. And we identified companies within each of those sectors that were upstream. So essentially pulling the commodities out of the ground for miners and for energy producers. For agriculture, there's a less clean connection there. So we just found companies that we thought would be most correlated to agricultural prices. So it could be machinery, could be fertilizer. And so we designed that index and made that a part of RPAR, so that's reflected in there today.
And then, Alex, how do you guys capture the gold exposure in the ETF?
Yeah, I'm glad you mentioned gold because we think of the commodity basket as falling into two subgroups. There are the commodity producers that Damien just described, and then there's gold, which is very different because it's more of a currency and a storehold of wealth. And what we've seen historically is in periods where growth collapses, like we saw in the first quarter of last year, gold went up and the commodity producers went down. The same thing happened in 2008. And now this year, you're seeing the opposite. Gold is down and commodity producers are up. So they're good diversifiers versus one another. So for gold, we don't want the miners. We actually want the gold bullion. So we just buy a gold bullion ETF that just tracks the price of gold. And then when you marry that with a commodity producer allocation, now you have a total commodity basket that has an expected return comparable to equities, return and risk, but it's going to be a better inflation hedge.
That's one thing that I think is different about our approach versus some of the other risk parity strategies, is that we use commodity producer equities as opposed to commodities. The challenge with commodity futures is it's questionable what the return profile actually is, whether there's a risk premium or not. So over the long term, commodity producers have outperformed commodity futures by a wide margin from a return perspective. We have more confidence in the equity risk premium than we do in whatever risk premium might be in commodity futures. And then you also have the benefit of a more tax efficient return stream, because if you're allocating to commodity futures, you basically have to realize the income every year. Whereas with commodity producer equities, you get that tax-free compounding outside of the distributions every year.
Got it. And I'm sorry if I missed it. The gold allocation exposure, if it's not from futures, are you using an ETF as a proxy?
That's correct.
Okay, excellent. And I'm surprised that you guys don't have gold miners in the portfolio, because I just would have assumed it based upon my experience with risk parity strategies that I've come across. Is that unique to RPAR?
I think most risk parity strategies either have gold bullion or they don't have any gold exposure. That's been my experience. And so, or they might have gold futures as part of the, like a Bloomberg commodity type of allocation on the commodity side. But actually, I think gold miners would be less frequently utilized in this context, just like commodity producer equities are less frequently utilized in this context. It's typically more the futures or the bullion.
Excellent. So Damien, what do we need to know about the treasury exposure in this ETF?
So the treasuries are a blend of 10-year treasury futures and ultra 30-year treasury futures. And the goal there is to get efficient exposure to the treasury market. The futures actually allow us to leverage the overall portfolio a little bit. So with futures, you can get a given exposure with less than 100% funding of that exposure. And the nice thing about futures is the embedded financing cost in futures is very close to zero. It's basically equivalent to the repo rate. So it's the cheapest form of leverage that we could find as we were thinking about different ways to leverage the portfolio. And as Alex mentioned, we have to structure the bonds to have an equity-like return, which means we have to add longer duration. We have to target longer duration and also add a little bit of leverage in order to get a similar return and risk profile to the equities and the commodities. So the futures are an efficient way for us to do that.
All right. So it's a good time for the leverage question and discussion. So is the leverage just applied here in the treasuries component, or do you see it in other places in the portfolio?
It's just applied in the treasury component.
Okay. And then what's the overall leverage ratio in the fund?
It's 20%. So for every dollar invested, you get a $1.20 of exposure.
Excellent. And Alex, what about the TIPS exposure? What do investors need to know?
Well, the focus there is long-term TIPS, and we just buy the physical bonds. And the objective of TIPS in the portfolio is it's a rising inflation, falling growth biased asset, and we need to get enough risk in that component to have it give you enough upside when those environments transpire. So that's why we focus on longer duration, just like we do with the treasuries.
Excellent. I love the story. Now it comes down to rebalancing. So is this a rules-based rebalancing approach, or are you guys taking an active overlay?
We're big fans of rebalancing. We found over time it actually adds, it helps diversify and get you back to targets, but it also enhances returns. When we look historically, you get a boost in returns, and conceptually it makes sense, because if you have 4 asset classes that over time give you comparable returns and risk, in terms of the contribution to the portfolio, and you're repeatedly buying low, selling high, which is what rebalancing is. You're selling some of the winners, you're buying some of the underperformers, and you repeat that process. That should add returns over time. And one of the challenges, actually, there's 2 challenges to rebalancing in typical portfolios. One is emotionally, it's hard to sell the winners and buy the losers. And number 2, oftentimes taxes get in the way, because when you sell the winners, there's going to be cap gains. So we are able to bypass some of those hurdles within an ETF structure. The rebalancing occurs automatically. It's rules-based. Every quarter we rebalance. We're not trying to time things. It's once a quarter. And then within the ETF structure, there's a lot of tax efficiencies that come with that.
Excellent. Gentlemen, I appreciate you coming on to share the story. For podcast listeners, you can learn more at RPARETF.com. That is RPARETF.com. Thanks again, gentlemen.
Thank you.
Thank you.